Life is unpredictable. We don't know what tomorrow holds, but we can prepare for it. What would happen to your family if you weren't around tomorrow? Could they pay the bills, the mortgage, or even the cost of your funeral? That's where life insurance steps in, a safety net that protects your loved ones when you can't. In this video, we're going to break down life insurance in the simplest way possible. What it is, how it works, the types of policies, and how you can choose the right coverage for your family. So stay tuned till the end, because this guide might just be one of the most important financial lessons you'll ever learn. At its core, life insurance is a contract between you and an insurance company. You agree to pay regular premiums, and in exchange, the insurer promises to pay a lump sum of money, called a death benefit, to your beneficiaries when you pass away. Let's simplify. Policyholder. That's you, the person who owns the policy. Beneficiary. The loved ones you choose to receive the money. Premiums. The payments you make monthly or annually. Death benefit. The payout your family gets after your death. Policy riders. Extra add-ons like critical illness coverage, accidental death benefits, etc. Think of life insurance as a shield. While you're alive, it may feel like just another bill. But when you're gone, it transforms into financial security for your family. Now that we know the basics, let's explore the different types of life insurance policies. There are two main categories: term life insurance and permanent life insurance. 1. Term life insurance covers you for a fixed period, say 20 or 30 years. If you die during that term, your family gets the payout. If you outlive the policy, it expires, no payout. Pros? Very cheap premiums. Cons? No cash value. Imagine you're 30 years old and you buy a 20-year term policy. If you pass away at 45, your family gets the benefit. But if you live till 60, the policy simply ends. 2. Whole life insurance. The most common type of permanent life insurance. Provides coverage for your entire lifetime. Builds cash value over time, which grows at a guaranteed rate. Some policies even pay dividends. Premiums are higher, but you're guaranteed a payout. Third, universal life insurance. More flexible than whole life. You can adjust your premiums and even your death benefit as your situation changes. Has a cash value that earns interest. 4. Variable life insurance offers investment options. Your cash value can be invested in mutual fund-like accounts. Higher growth potential, but also higher risk. The takeaway? If you want something simple and affordable, go for term life insurance. If you want lifetime coverage with savings benefits, choose permanent insurance like whole, universal, or variable. So, how does life insurance actually work behind the scenes? When you apply for a policy, the insurance company checks your health records, lifestyle, and sometimes even requires a medical exam. This process is called underwriting. Why? Because the insurer wants to know the risk. How long are you likely to live? Once approved, you pay your premiums regularly. These premiums are split into 1. Company's expenses and profits. 2. Cost of insurance for your death benefit. 3. Cash value, if it's a permanent policy. If you stop paying, your policy may lapse, meaning no coverage. But here's the good news. Death benefits are usually tax-free for your family. If you have permanent insurance, your cash value grows tax-deferred, and you can even borrow against your cash value while alive. Now, why should you even consider life insurance? What's in it for your family? 1. Final expenses. Funerals can cost nearly $8,000. Life insurance ensures your family isn't burdened. 2. Income replacement. If you earn $50,000 a year and suddenly pass away, your family loses that income. Life insurance can replace it. 3. Debt protection. From mortgages to car loans, insurance can wipe those debts clean. 4. Education costs helps pay for your kids' college. 5. Retirement savings. Permanent insurance doubles as a tax-deferred savings tool. 6. Legacy and charity. You can leave behind wealth or donate to causes you care about. 7. Estate planning. For wealthy families, it helps cover estate taxes. Here's the big question. How much life insurance is enough? There's no magic number, but experts suggest 3 approaches. 1. Multiple of income rule. Multiply your annual income by the years you want covered. Example: $50,000 times 20 years equals $1 million. 2. 10 times income plus college costs. Income times 10 plus $100,000 to $150,000 per child for education. 3. DIME, formula D equals debt, I equals income replacement, M equals mortgage payoff, E equals education. Add them all, and you'll get a realistic coverage number. So, how do you actually get insured? 1. Decide what type of policy you need. 2. Get a quote online or through an agent. 3. Fill out the application. Age, health, tobacco use, etc. 4. Undergo medical exams if required. 5. Once approved, sign the contract and pay your first premium. Some policies called guaranteed issue don't require medical exams, but they offer very small benefits. So, do you really need life insurance? If you have dependents, debts, or anyone who would suffer financially after your passing, the answer is yes. If you're single with no dependents, maybe not right now, but buying young can lock in affordable rates. Remember, life insurance is not about you. It's about protecting the people you love most. So take action today, because tomorrow isn't guaranteed.